What are Donchian channels? Donchian channels were developed by Richard Donchian, who is often referred to as the father of trend following. Donchian channels consist of three main components. First, the upper band, which represents the highest price over a specified period, typically 20 days. Second, the lower band, which represents the lowest price over the same period. And third, the middle line, which is simply the average of the upper and lower bands. Let's see how Donchian channels appear on a price chart. Here we have a price chart showing 20 days of trading activity. The upper band tracks the highest price over our look-back period. The lower band tracks the lowest price over the same period. And the middle line is simply the average of these two bands. Together, these three lines form the Donchian channel. Let's look at how traders use Donchian channels in practice. Traders use Donchian channels to identify price breakouts, determine trading ranges, and generate trend-following signals. When price breaks above the upper band, it may signal a bullish breakout and potential buying opportunity. In summary, Donchian channels are a powerful technical analysis tool that capture key market information. They show historical price extremes, adapt to changing market conditions, and provide a simple yet effective trend-following framework. Donchian channels consist of three key components, each with a straightforward calculation method. The upper band represents the highest high price observed over the last n periods. The lower band represents the lowest low price observed over the last n periods. The middle line is simply the average of the upper and lower bands, calculated by adding them together and dividing by 2. Let's visualize how these channels are calculated using a sample price chart. The most common setting for the period n is 20, meaning we look at the last 20 price bars to determine our channels. For each point on our chart, the upper band represents the highest high price within the previous 20 bars. Similarly, the lower band represents the lowest low price within the same 20-bar look-back period. The middle line is calculated by taking the average of the upper and lower bands at each point. Unlike many other technical indicators, Donchian channels don't require complex mathematical formulas or weighted averages. Traders can adjust the period setting based on their trading time frame and strategy. Shorter periods create narrower channels that follow price more closely, while longer periods create wider channels that filter out minor price movements. The simplicity of Donchian channels makes them accessible for beginners, while their effectiveness in identifying trading ranges and breakouts makes them valuable for experienced traders as well. Donchian channels are particularly effective when trading range-bound markets. Range-bound markets move between defined upper and lower boundaries without establishing a clear trend. Donchian channels clearly identify the boundaries of the trading range, making them ideal for range trading strategies. When prices approach the upper band in a range-bound market, traders might consider selling opportunities, expecting prices to revert toward the middle line. Similarly, when prices approach the lower band, traders might look for buying opportunities, again expecting a reversion to the mean. The middle line often acts as a dynamic support or resistance level in these market conditions. When price falls to the middle line, it may act as support. When price rises to the middle line, it may act as resistance. This range trading approach works best when markets lack strong directional momentum, consistently respect the channel boundaries, and maintain relatively consistent volatility. However, be cautious of potential breakouts that may signal the end of the range-bound conditions and the start of a new trend. Donchian channels gained significant popularity through their use in the famous turtle trading system. The system was developed by Richard Dennis and William Eckhart in the 1980s. The turtles used a 20-day Donchian channel breakout as their primary entry signal for trading. The Donchian channel consists of two lines. The upper band shows the highest price over the past 20 days, while the lower band shows the lowest price. The turtle trading strategy had two simple rules based on these channels. They would buy when the price exceeded the highest high of the previous 20 days, creating a breakout signal. This systematic approach to trend following produced remarkable results and cemented Donchian channels as a staple indicator for trend traders. Combining Donchian channels with other technical indicators significantly enhances their effectiveness and helps confirm trading signals. Volume indicators can confirm the strength of Donchian channel breakouts. High volume during a breakout suggests strong conviction from market participants, increasing the likelihood of a sustained price move. Momentum oscillators like RSI or MACD help identify potential reversals when price reaches the Donchian channel boundaries. When price hits the upper band with an overbought RSI reading above 70, it may signal a reversal. Many traders use moving averages with Donchian channels to filter signals. A common approach is to only take long positions on upper band breakouts when price is above a 200-day moving average, confirming an overall uptrend. By combining Donchian channels with these complementary indicators, traders can develop more robust trading systems with higher probability setups and fewer false signals. Despite their popularity and usefulness, Donchian channels have several limitations traders should be aware of. Let's examine 4 key limitations of Donchian channels. The first major limitation is their tendency to generate false signals in choppy or sideways markets. In markets that move sideways with short-term volatility, price can briefly break above or below channels without establishing a true trend. These false breakouts can trigger multiple losing trades as the price quickly reverses back into the channel. The second limitation is that Donchian channels are lagging indicators based on historical data. When sudden price movements occur, the channels take time to adjust, potentially delaying entry or exit signals. Notice how the upper channel only gradually follows the price action after a significant move, creating a lag in signal generation. The third limitation occurs during periods of low volatility, when the channels become very narrow. Narrow channels can cause even minor price movements to trigger breakout signals. These small breakouts are often just noise rather than meaningful trend changes, leading to poor trade quality. The fourth limitation is evident in highly volatile markets, where channels become extremely wide. Wide channels create significant challenges for risk management. Stop losses may need to be placed at significant distances from entry points, leading to poor risk-to-reward ratios and potentially large losses. Understanding these limitations is crucial for using Donchian channels effectively. Being aware of these challenges allows traders to use Donchian channels more effectively by applying appropriate filters and secondary confirmation indicators.